Good morning, everyone. So, we've been talking for 4 lectures we've been talking, last lectures. 3 lectures started talking about brand valuation, inventory. So, last class we had spoken about inter and brand valuation. Now we talk about another 2 concepts we call. One is your brand finance and one is your BrandZ. That is vendor brand. And they are interrelated. Internet was little complex because we have to calculate what you call your role of brand index and then brand strength. Okay. Brand finance is simple compared to when you talk about internet. And BrandZ is also quite simple. So we will talk about all these brand factors. So let us look at brand finance. What we are doing. We are originally based in UK. Okay. So we are conducting market research annually of 6,000. That is what we do. 6,000 brand. Annually we are conducting research and we are taking respondents of 1,75,000 across 41 countries. So we have been studying across 41 countries. And then we are one of the largest brand having database in the world. So when you talk about the database, we are one of the largest brand value database. So if you look at their valuation, so this is the valuation of top 10 companies in India. We are not talking about one obviously we can look at the website and type of it. So number 1 brand as far as their internal is category. Maybe a BPCS is included, I guess. So their total value of data group is 31.6 billion, and the global rank of data group is 60. Okay. So that is the global rank of data group, and it is the top brand followed by Infosys, then your agency group. So they are talking about the group here, bank and agency group. Then we have LIC, which have been carried from since the childhood days. So sort of the brand that has to LIC also. So your LIC, your Reliance, SBI, ACL, Rajeshri was making presentation on yesterday, which is a relate. Then guarantee and Mahindra. These are the top brand in India based on their calculation, brand finance calculation. We talk about calculator. So mostly what they use royalty related method. Unlike your brand finance, intra-brand is to take economic profit. So in case of intra-brand, we find out economic profit and then discount. Here, in this case, what they are doing is what? They are forecasting the revenue and then calculating the royalty as a percentage of revenue. Okay. Suppose if I have to hire their bank, if as a company I want to hire their bank or start a franchise, I need to pay royalty. So notional amount I have to pay. So that is calculated in terms of percentage of revenue. So that is what exactly we are doing. So it is based on the royalty method, and we are using for 2 reasons. Okay. Number 1 reason, it is favored by the tax authorities or what. So whenever there is a dispute, it's very simple and it is favored by tax authorities, unlike your intra-bank. So they use this method because if you look at the brand valuation standard ISO, so they say okay, here this highly recommended use the royalty method because in case of litigation also, this method is more suitable compared to income. And then it is done based on publicly available information. So nothing more data you collect and go to the companies and collect those data. It is based on fully public available information. Simply how it is done, you estimate the future sales. So very simple. Tool is very simple, nothing complicated. So I am today I am here. So I estimate the future revenue. This is what I do. I calculate the future revenue. Revenue means sales. So today you have to calculate a brand value of a particular group or a group. I estimate the future revenue. and then try to find out how much of that revenue is contributed by that particular. So, if I am trying to do a product, if I am trying to do a company, simply I calculate the revenue for next 5 years and then we do it for 100 years. So after some point of time, we again do it, we find out the terminal value and then do it. Okay? So we calculate the revenue for next few years. Very simple. So once I calculate the revenue, then I find out the royalty rate. How much royalty rate I have to pay if I start using their brand. So that rate I attach to it. I calculate. This calculation, whenever I do this calculation, is based on certain brand state. So I need to calculate the brand state in your entire. How much royalty should I attach to that? 4%, 5%. You need to decide the rate. So how do you decide the rate? Based on the state of the brand. Okay? So I have a royalty, suppose it's 4%. So I calculate the revenue, forecast the revenue, very simple. I have a brand and forecast the revenue for the next 100 years. Okay? I calculate a royalty rate, notional royalty rate, and then I get a royalty income. Simple. So I get a royalty income. So this income, whatever I is earning, it is before tax. So I need to pay tax. If I am earning income, I need to pay tax to the royalty. So what I do? I give a tax rate and then subtract. So I get post-tax royalty income. Okay, this is post-tax royalty I get for so many years. And then I calculate the present value. Simply because the earning I am going to earn in future. So what I do? I calculate the present value to arrive at that. It will be simple compared to what we have studied in the brand. So this is the methodology they are using. Okay. Let's see. First we need to do their same. They are calculating a brand state. It is expressed as a percentage of BSI score over 100. So I have some parameter based on which I calculate the brand state of a particular company or product. I find out and it is expressed in terms of percentage. Maybe start from 0 to 100. So brand state index is derived from the brand. First is the investment they are going to make in the brand investment, that is what. Then the equity, brand equity with studying so many models is studying, they have their own model. Okay. And then the performance of the brand, how that brand is performed. So based on this, they calculate the BSI, brand state index. And then they will decide the royalty. How do you decide the royalty? Maybe high, it will be low. You got a sector or royalty. So first thing I can compare. If similar thing is happening in the market, I compare. If that data is not available, I use this data to find out what royalty I should charge. So which brand will have less royalty? The strong brand will have higher royalty. So for example, I decide the royalty of this sector is 4 to 8%. Suppose the sector royalty is 4 to 8%. Now if a brand state is 80, so what will be charging? So if it is 100, we will be charging 80%. If it is 0, we will be charging 4%. So depending on 80%, we proportionately calculate the royalty rate. So this rate is being decided from your state of the brand. Okay. So similar to what Interbank used to do, they have used calculated brand state, but there the BSI brand state score was decided to use what? To find out the discount rate. If your brand state is high, your discount rate will first go in case of intra. But here we are not deciding about the discount rate. Here what we are deciding to find out the royalty. This is the difference between what we have studied in the last class and what we have seen in brand finance versus Interbank. And then we are trying to forecast the revenue. This is what I So multiply this into, so three multiply factors. One is BrandZ index, 80%, 50%, 50, 80, whatever score it is. And then we have a range of ROI. Okay. That range, we need to pinpoint now. It should be 4% or 8%, we need to pinpoint exactly, because we need to quantify. Okay, there is no qualitative aspects. Whenever we are talking about brand health, there is no qualitative aspects. We need to quantify, we need to pinpoint. That is what we need to do. So we need to find out the exact. Okay. So this is what we are doing. We are multiplying this into this, and then forecasting the revenue, then deducting the tax, and then find out the present value. Discount rate we get present value. So we get a brand. That is what regular and every.
Hello and welcome. I'm Alex A, Managing Director of Brand Finance Asia Pacific. When we talk about the building blocks of brand value, we often talk about it as a chain. You make an action which results in stakeholders holding a better opinion of you, which should, if combined with an effective company in a growing market, itself lead to higher brand value. Ultimately, the strength and value of a brand comes from a well-known reputation for offering good products and services consistently. But, as marketing teams, ensuring that the business's strengths deliver the reputation that's deserved, good brand governance combined with appropriate marketing investment is key for delivering a strong brand. That, combined with the business's financial outlook and size, lead to brand value. Now, brand strength is a key input to brand valuation calculations. It refers to the cumulative familiarity, reputation, and appeal that the brand commands amongst stakeholders. This should allow brands to sell more at higher prices, and in some cases, increase loyalty and increase the efficiency of marketing. And as I mentioned, we like to consider building brand value and strength as a chain. Inputs lead to perceptions, which lead to behaviors, which then allow you to invest more in actions, which can improve perceptions. This means that when we analyze brand strength, we consider perceptions, which includes familiarity as an amplifier of perceptions, but also behaviors in the form of usage and willingness to pay a price for it. We also analyze diagnostically why brand perceptions are as they are in order to give feedback on what to focus on and to improve. These data points, which are collected from our global market research study, placed in a scorecard and benchmarked against competitor brands to deliver a score out of 100. The market research we complete in order to analyze brand strength is conducted across over 30 sectors in 40 countries and covers over 6,000 unique brands. The total number of respondents is over 150,000, and in Asia Pacific we cover 12 countries, with China including research both on the mainland and in Taiwan. We cover the core brand funnel measures along with overall reputation, questions about sustainability, likability, and other KPIs. Additionally, we research diagnostic attributes that help to explain overarching brand perception indicators. Important to note is that we also have tiered research. In markets where we have none or a smaller number of subscribers, we restrict the research to a summarized version, covering just the most important summary metrics. We call these Tier 2 and Tier 3 markets for B2B sectors. Here, we focus on some key brand metrics. These core metrics can be very useful for summarizing the main fundamentals of strong brands. We do this by focusing on three core areas. Firstly, familiarity, which is an amplifier and multiplier of perceptions, and is usually highly affected by marketing activities. Then, assurance, which refers to brands meeting the needs of customers consistently and effectively. And finally, appeal, which refers to the emotional connection that drives interest and cross-sell, and that only the best brands can command. Brand value is a monetary concept. It refers to the current capital value of the earnings that a business derives directly as a result of using the specific brand on their business rather than a generic alternative. These earnings are owned by an organization through the control of trademark rights. To compare the concepts, brand strength is non-monetary and delivers a score out of 100. Brand value is monetary and delivers a financial figure in the currency of your choice. Brand strength indicates the power of a brand at the point of purchase. Brand value combines this power with a slice of the business to which the brand is being applied. For brand strength, staying steady is a victory. Anything above that is a great result. For brand value, the key is to grow faster than competitors. Brand strength is used for tracking and clear comparative metrics. Brand value is used for return on investment analysis, marketing investment management, and tracking as an additional component of brand health and strength evaluations. As I mentioned, a key use of brand valuation is to understand the return from different actions, whether it's a new brand architecture or a change in marketing activity for investment. By analysing the likely impact on brand strength and other assumptions, you can start to understand what the potential value increases or decreases you can expect are from specific decisions. Or you can start to understand what the impact of actions or activities has been in the past.
These are the steps. Okay? Based on their result. What they do, first they obtain the brand specific financial and individual. So if you want to find out the brand value, first what you need to do is to find out the brand specific financial and individual. And what are the sources by which you collect? The company data, websites, the company websites, the revenue data are here. Then toolbox website, company website. Sometimes people who are investing in the stock market, they have their own forecasted data of this. Basically, somebody wants to invest in the stock market, what they do, they give a forecast for next 3-4 years. So I can use that data to predict, okay? Then you need to model it. Model means you need to forecast the future. So that is based on what? Today I get a calendar. Okay, so what you need to do, find out the brand value, you need to forecast. You need to forecast the revenue for upcoming years. So that job you have to do. So you have to model it. So based on what? Based on maybe one way is what to find out the GDP growth rate and then try to correlate with the GDP to revenue growth. That is one way you need to do. So I need to find out, suppose today I want to analyze a company in India, so I need to find out what would be the revenue for a category for next 5 years. So I need to understand whether Indian economy is going to do well or not. If you feel that they are going to do well, then based on that you need to forecast. What should be the revenue of data group, what should be the revenue of Infosys, or maybe a lot of companies are tracking, a lot of fund managers are doing those kind of analysis. I can take the data from there and then focus. So this is one. And then I said it is very difficult to predict after beyond 5 years. So we will grow it, perpetuated growth. Maybe 2%, 3%, you can attach a perpetuated growth rate. And then we calculate the terminal value from 50 year onwards. So we have a terminal value, and then we, so once we do this, the next step is what? You have a notional royalty rate for each plan. So you need to decide what should be the royalty. That is the most crucial because your brand value depends on that. Okay. Revenue you have forecasted. Now your value of the brand will depend on the royalty. So you need to have a clear cut what should be the royalty. So you need to establish the royalty. Okay. So first thing is what? In regards to the comparable licensing agreement and industry norms. So a lot of industry, they have a franchisee, other norms, so they have their own royalty rate. So you can take that, number one. Second is compare the royalty rate with the operating margin in the industrial sector. So you need to take the operating profit margin, EBIT margin, earning before interest and tax, margin of that, and then find out the royalty. Okay, there is a thumb rule. There is a thumb rule within licensing industry, the rule of 6-25. So what is that? If your profit margin is 20%, profit means EBIT margin is 20%, earning before interest tax is 20%, we multiply 0.25 and then get the royalty. Very simple. Okay. So suppose this is on average expect between 25% to 40%. So mostly if you take 25%, suppose the profit margin of the company is 20%. Profit margin means EBIT is 20%, we take 25% of that, we get 4%, and upper limit is 40%, we get 8%. So somewhere your royalty rate has to be 4% to 8%. Now, whether it will be 6%, whether it will be 8%, that depends on the BrandZ index. That is next step. So you need to establish the appropriate rate within the range. So you're first you're deciding the range. What should be the royalty rate range for that particular sector? Once you've decided, now you need to find out pinpoint the actual rate. Okay. So here also they have one analysis. They do the BrandZ analysis. Okay. To find out the risk factor whenever you invest in that brand. The BrandZ. So brand finance they calculate brand beta. Those who are in finance, they know what is beta is. So we are trying to find out the risks of a company. In just in the stock market, we calculate beta to find out the movement of particular company's share with respect to the market. So that is beta. So how much risk are we going to take? Same here, they use the same calculator. Okay? So they calculate the brand beta. They have given the name from stock market, brand beta. They are trying to find out the risks of that brand. And that is expressed in terms of certain symbols. Like whenever you are investing in debentures, whenever you are investing in fixed deposits, what do? You rate your company. You go to BC. There are a lot of rating agencies which are available, which will give you a rating. Even India has got a rating. You know that? India has got a rating. Rating is given by a rating agency, Moody's. They said, okay, India market is stable, unstable, okay, risky, things like this. So you got a rating. They give rating to India also. Same happens here, they are trying to rate the brand. That is called brand beta and they give a rating. So this factor, rating is done based on certain things which was explained. Your input phases and your brand equity output phases, three factors. So you take input, you take quality of brand management, brand presence. So when you calculate functional performance, emotional connection, the brand preference. So these are all your brand equity. So you measure the brand equity. And then obviously you would have performance, brand performance. What is that? Revenue growth, market share, profitability. So and then you would analyze. So based on that, they give a score and then they give you a rating. If you get A, triple A, that means your brand is exceeding strong. If you are rate triple A, that means your brand is exceeding strong. If it is triple B, the brand is very strong, weak, and then you would have a strong. Very similar to rating given by the 10 rating agencies in India, CRISIL, KR, ICRA. So they give a rating. Whenever you want to issue bond, debentures, you need to get rated. Same thing, they give a rating. Extremely strong, very strong, average, weak, and this. So you are rating rated. So this is called the brand beta. So what you do? Then once you calculate, then discount rate, specifically is brand. So discount rate you calculate based on maybe cost of your capital. So you apply discount rate. So I got a future scheme of royalty income. I apply the tax. I get post royalty income based on their withdrawal. Then I discount it. So whenever I discount it, I need to have a rate, and this rate is based on the cost of capital. Okay. They calculate the cost of capital and they discount, and then I get a rate present value. So this is what they will do. So anybody has doubt here? So these are the survey questions I have collected from the research. So if somebody is interested in doing research, what kind of question he is able to ask. So this will give you some idea. That's what I given idea. This is directly from the research. So this is the brand model. So your matrix of measurement. This is the brand imaginary concept matrix, easy to get, good connection, genuinely offer something with it. So we need to have a step. Okay. So this is the brand knowledge. We are trying to test whether the respondents have got the brand knowledge or not. So which are the following brand, please indicate how well you know it. Awareness level, candidate, so they are talking of knowing your brand. They will understand whether you like to implement your brand to others or not. So that will give you great promoter scores, which are talking just a net promoter scores, whether you get seen as a brand promoter or not. Then loyalty, consideration, usage. So these are questions related to this. So they are given survey questions which are related to each of these parameters. Okay. So brand knowledge, don't listen, brand activity, sentiment, happy, price premium, bottom home, sustainability. So based on these questions, they collect data. They said they collect data from 1,75,000 respondents. So these are the some questions they do a survey. And then try to find out the brand state and then brand become. Okay. So that is how they calculate. So if it's interest, you can start if somebody is wanted to research. A lot of studies are done on collecting primary surveys. This will be the group. Obviously, you can have your own standard questions. You can modify and do thoroughly analysis. You have a question. This is what we will take an example. The method we have discussed. We'll just take an example. If we have decided what I said is okay. You need to forecast the revenue, sales. So this is the sales for 10 years. So if you are, this is your projected sales for next 10 years. So first step is what you need to estimate your sales. So what I have done is these are all your projected sales for next 10 years. Now you need to have a royalty income. So you have to decide the royalty rate. So we have hypothetically we have taken 7%. So this royalty rate is decided based on your brand strength. So you have a score, find out the range. From range, you find out the exact rate. So this is, so if sales is 102, 7% of that is your royalty income. This is your revenue, say 7% of that is your royalty every year. 7%. here your tax rate is 30%. So this is your after tax rate. So from here, you calculate 30%, subtract that, you get after tax. Okay, so simply this is nothing but you do here. This is 70%. So 30% as affected tax. Okay. So royalty income minus tax, we get after tax rate. So this is after tax. 70% of this is your after tax. So this is what we get after tax. So from here, we are not calculating. Up to 10 years we have calculated. Beyond 10 years, we are not going to calculate. We assume a growth rate. What is that growth rate? We call it is a participative growth rate. So we assume the revenue to grow at a rate of 3% from 10 years onwards. From 11th year, your revenue. From 11th year onward, your revenue will grow at a rate of 3%. And then we calculate this, we calculated for terminal value. So from here we calculate terminal value. What is this terminal value? This value into next year is what? 3% of this. You are standing here. What is terminal value here? Your revenue in your income, revenue. Royalty income 11th year. So this is your terminal value at the end of 10 years. So at the end of 10th year, your terminal value will be what? Royalty income in the 11th year divided by R minus G. R is what? Discount. G is your growth rate. So this is what you have calculated. Okay. Divide by 0.12. Your growth rate is, discount rate is 15. Participating growth rate is 3. 12. Okay. And the 11th year revenue is this into 3%. So the growth rate is 3%. So we get a terminal value. Okay. The value at the end of, starting from 11th year to infinite year. Okay. So we have a terminal value and we have the values for 6 years. We have a income, royalty income for 6 years, and this is the royalty income from 11 to infinite year. So you have two components. One for first 6 years you have got an income each year for 10th year. And then here, all this is the cumulative sums of income of all other years, till infinity. Okay. Now what you have to do? You have to calculate the present value. So how do we calculate present value? This you have to multiply by 1 divided by 1.15. So like this 1.15 square. So instead of that, what I do? We use Excel, which is available in Excel. We use a function called NPV. You don't need to calculate all this. So simply we have the NPV, net present value. Okay. So you go to Excel and find out net present value. What is the discount rate? 15% you have taken. And what is the value here? This. So automatically it calculates the net present value. So we don't need to calculate now. So last class you are doing it, but if you know a little bit of Excel and a little bit of finance, it's very easy. It's just a second job. So what you are doing is calculating the NPV, taking 50% as the rate and we are giving a range here. And this also we are converting into present value. This is the value at the end of 10th year. So you have to convert into present value. This is the value at the end of 10th year. So again we have to convert into present value. So this has to be 1 by 10. So that value I have taken. So this value plus this value is your total brand value. We have assumed the royalty rate to be 7%. Okay. change it to 5%, royalty rate. See the brand value. So we can have a sensitivity table now. Okay? 5% what is the value? 7% what is the value? 8% what is the value? You can have your own table. You can do anything you like. Once you have done a little bit of quick calculation in Excel, with formula being applied, you can do all these sensitivity analysis. If royalty is 5%, what will happen? Royalty is 4%, what will happen? If I change the discount rate to 14%, what will happen? You can see the effect in the value of the bank. Okay. So here we have changed 7%. If it is 7%, then what does the value? What was the value? 45. Okay. If I make it 5%, 30. So this royalty rate plays a major role in deciding the bank. And this royalty rate they calculate based on the BrandZ. Nothing more, very simple. But brand strength is a qualitative one. We collect data and then compare with the industry and then give out that BrandZ. So there you need to do a lot of primary survey, secondary data. You need to carry on and find out brand strength. This is how you use a royalty method to calculate. This is how the brand finance there is. Everybody has known how this brand is calculated based on the brand finance. So simply use royalty rate. We need now here very simple. So here, what dimensions you have taken? The royalty rate. The brand finance, what they are doing? They are estimating royalty rate based on your brand strength, brand beta. Okay. These participatory growth you have taken 3%. This growth you can calculate based on GDP growth. It makes very simple. You can take as a GDP growth as a proxy for participatory growth. If you feel Indian GDP growth is 5% from 10 years onward till infinite view, you can take, except you assume the participatory growth to be 3%, 4%, to be on the second side. Then this discount rate. Discount rate, I have taken 15%. You can maintain less. Okay. It depends on the cost of capital of that particular company. Mostly this is on the higher side. I have taken 15%, but maybe it should be around 12%, because whenever I am investing in a Tata Group company, I am expecting a return of 12%. My stock return should be 12%. I will be happy if I get a 12% return if I invest in a Tata Group shares. Okay. Because if I put my money in the bank, I get 8%. So 12% is fair enough. So I can assume the discount rate will be 12%. Okay. Tax rate, you know, this is higher side, 30%, but it is 25%. Current tax rate is what? 25%, around 25%. You can tell me, what is the tax rate, sir? Current 25%, what is the tax rate? 25%. So you can assume 20%. So it will be more realistic. If you assume 12%, you can assume it to be 25%. You can find out the brand based on your royalty rate message. Now, this is the other method we keep talking.
Since 2006, Kantar BrandZ has been
But information availability is very less in
the
case
value
of
of the world's strongest brands. A brand is one of a company's most valuable assets. Our data shows that on average, brands account for close to a third of a company's value. For the highest performing brands, it can be more than 50%. Brand value depends created by the branded business, its financial value. To determine the role of brand contribution, the value driven by brand perceptions, the next step is to peel away a few more layers to assess the brand's ability to attract more consumers or to charge more for it. We use Kantar's unique survey-based brand equity model, which measures how meaningful, different, and salient a brand is. These tell us the brand's influence on consumer behavior to grow demand and penetration. And it further quantifies pricing power, the brand's ability to charge more and deliver higher margins. These together connect brand equity to value creation, where the deepest value of Kantar BrandZ's unique brand measurement lies. We know what motivates consumers and marketing's critical growth accelerators. Kantar BrandZ tells us how a brand is driving value for its business and how strong its future prospects are. Let us argue with tangible evidence of the value delivered by your company's greatest asset.
If you see their presentation, I think this is how what they are doing. Okay? By the time you find out the value of the brand, it is based on, if you summarize whatever editorial information, detail community, so very difficult to get the information from the website. Unlike brand finance, they are more transparent. Here, the information are not available how to explain the brand. Still, from their whatever aggregate, this is what we calculate the BrandZ value. We say the value of the brand is your last unit of the time of the brand in earning. So which earning definitely it is not clear. Okay? Earning means whether when in finance we call of earning, we normally speak of profit after tax. Okay? Earning means profit after tax to us. I don't know whether they take profit after tax or not. Either they will be taking profit after tax or maybe they are taking EBIT. Either of these two. It's not revenue. So either they take EBIT or they might be taking PAT, profit after tax. So when I talk about this is the branded earning. The earning earned by the brand, solely by the brand. Okay. Then I use a brand multiplier. So this brand multiplier will depend on the brand score. Take it, so. Like we have been discussing brand multiplier. In one example, we have spoken about the brand multiplier. We have given 7 parameters and then calculated the multiplier. So we are using a multiplier. You have got a current earning. If your current earning, for example, is 100 crore, and then you use a multiplier. Okay? Multiplier maybe 12, 30. So you will apply multiplier. Okay? You get and then multiply the brand quantities. See, a particular product may be sales of a particular brand may be 100 crore. Okay, profit may be 100 crore, EBIT 100 crore. Out of that, 100% may not be into the brand. It may include other features also, other intangible things, other features also. So you exclude. Okay. So if you exclude that, how do you exclude that? So that here you calculate the brand contribution. Out of that earning, how much is contributed by the brand name and logo. Okay, so you have got a brand earning total. Out of that, how much is because of that logo and that name, how much purchases we made from that one. So that is what is brand contribution. So step 1. First I calculate the brand earning. I got a corporate earning. Okay. So if I take a a company earning, that is a total earning. That earning may have 3-4 brands. So I have to find out very specific. So there we apply activation rate. Out of this total earning, how much earning is by that brand. So this is the total corporate earning. From there you find out of that is 50% is from that brand. Okay. So that rate you can find out, which from the activation rate, maybe 50%, 60%. So that becomes a brand rate for particular brand. Step 2 is what you give a financial brand. What is the financial value of that? So there you use a brand multiple based on your brand scale, 11, 12. Okay? And then from this total financial value, how much is attributed to the brand. So then you get a brand. So this is how this method is very useful. So this is the explain. Suppose a corporation is holding many brands. So I get a corporate brand. And then earning of the corporation need to be allocated across the portfolio of brands. So we have got a various brands, a company might carry 10 brands. So if you have to calculate the specific, I need to find out the ratio to apply, certain ratios to be applied. Okay. Suppose what I get in the income statement, I get a total revenue, total earning. I get a total earning. If I look at Hindustan Unilever, I get a total earning of Hindustan Unilever, not specific to the brand. Now if I take a particular brand, I will find out how much is the sales of that particular brand, or the earning of that particular brand. So that is what we are trying to do here. Okay. And this financial information is collected from the annual reports, and they are a huge database. Because they are doing it over a period of time, so they have a huge database. So they calculate. And these corporate earnings are multiplied by the ratios, proposal. Or the proposal to find out the brand earning, particular brand. So information supplied by Bloomsburg, okay, and other information they collect, they calculate a brand multiple. The current brand earning has to be multiplied into something to get a total brand. It's like arriving at a stock market, okay? Stock price. So stock price, what you do? Very, very similar. In case of stock price, if you have to arrive at a price, what will be the price of Reliance after 3 years? Very similar kind of thing. Suppose today I have to estimate what will be the price of Reliance after 3 years. So what I do, I estimate the Reliance earning next after 3 years. When I say earning means I estimate the profit, because ultimately the profit is distributed as a dividend to the shareholder. So what I do here, I estimate the profit after 3 years. So estimated profit. Estimated earning. When we are talking of earning, we are talking estimated profit after tax. So we estimate what will be the profit of Reliance after 3 years. Then we multiply into a multiplier. So that multiplier is called P multiplier in case of stock. Price earning multiplier. P multiplier. How much investors are willing to pay for every share of earning. So P ratio. So we have got a P ratio to find out. P ratio is current market price divided by EPS. So we get a multiplier. Suppose the Reliance multiplier P ratio is 10. So 10 means what? For every rupee of earning, the investors are willing to pay 10 times. So if Reliance has earned 1 rupee, the investors are willing to pay 10 rupees. If Reliance earning is 250 rupees today per share, if P ratio is 10, that means the price of Reliance will be 2,500. So you multiply. Same thing we are doing in brand values. Very similar. That is what they have done. I think they have taken all this concept from stock market. P multiplier. So you are multiplying estimated earning and P multiplier. Now how do you calculate that P multiplier? It's based on the past data. Past data is available. Last 10 years, what is the P ratio of Reliance? That is available. Okay? So that factor is available. So what I am doing is what? I have an estimated earning and then multiplying into P factor and then trying to arrive at a share price. Same thing we are doing here. What we are doing is what? I am going to branded earning, and then multiplying into a brand multiplier. Maybe 10 times, it may be 12 times, maybe 15 times. Okay? So I get a branded earning. So this branded earning is not interconnected to the name and logo. What I do, you need to segregate other parameter from it design. So there the contribution will come. Out of this total 100 rupees sold by the brand, how much is attributed by the brand? That is what is called brand contribution. That is what we are trying to find out. Next, that is what we call brand contribution. It may be other factors. I buy a toothpaste because I may like the price, I may like this. So that is not due to the brand. So when you talk of a brand, it is simply the name and logo, how much percentage I attach. What is the importance of the brand name whenever I buy the product. So you need to peel out those factors out of total branded revenue. Okay. Suppose the sales of the Tide in India is 100 crore. So out of that, how much is due to the brand name of that particular company? I need to peel out 50%, 60%. So that becomes a brand product. So when we talk of this BrandZ, essentially see this. So this is the methodology in very simple steps. Okay? The branded earning, which you have estimated, okay, into the brand multiplier, very similar to estimating the share value. You need to attach a brand multiplier. Current earning, current brand earning, okay. Let me put it very simple, like we got the Excel, Sharp Excel. So current earning of Sharp Excel into a multiplier because we are trying to estimate the future. So we are attaching a multiplier. So that multiplier is maybe 10, 15, 20. So you have a multiplier. Then out of that, you need to find out how much is that earning is contributed by the brand. So then you get a brand earning. That is what the BrandZ is doing. That is what I get from your information available to the website. Okay. So first brand earning, corporate earning, you don't get a brand earning. If I look at the annual report, I don't get the brand earning. What I get? I get the total corporate earning. So corporate earning has to be broken up into various brands, combination. If I got a portfolio of 10 products, so each product will have their contribution in the earning. So you need to find out that ratio. So that is what is called attribution rate. Simply proportion. Out of 100 rupees sales, how much is being proportionally sold by particular brand. So that is what is called attribution rate. Branded earning is attribution rate. So you get a branded earning. Then financial value, total financial value, you are giving a multiplier. So branded earning into brand multiplier. You get total value. And then from total value, you are trying to segregate how much of that is due to particular name of the brand. So they get a brand value. That is what BrandZ method. Okay. So based on this, they are estimating. Okay. So this is what the value of top 10 companies in India in 2024. Okay. That is what they have estimated. TCS, again we find the TCS. We have seen TCS in all three methods. Interbank TCS, there we have got a Tata Group, here also you have got this. But the value is different. If you want to take up, you can take out all these values and find out how much value is calculated by interbank, how much value is by brand finance, how much is value created by this. You can do that. Okay. Next is the agency bank. The Airtel is number 3 here. You know, 2024. Infosys is 4. So these are all standard. So Reliance Jio is here in the new entity. Let's try to find out Reliance here is new entity. And I was reading that Zomato is the fastest growing brand based on the asset. Zomato. The growth rate is fastest in Zomato. So as a investors, if you are really investing in stock market, I may bet on Zomato based on their stock because it is the fastest growing brand. But interbank will not come, Zomato will not come because they are not making economic profit. Here it might come because this year the company has made a profit. So company's earning is there and we are multiplying into brand multiplier. So the position of the Zomato was 31st and the fastest growing brand. So this is in 5. Okay, this is our 3 methods we have discussed. So interbank and this. More process, somebody is giving brand multiplier, somebody is using BrandZ to arrive at a discount rate, somebody is using the BrandZ to find out the royalty. So essentially, all we are looking is the future estimated revenue that brand is going to generate. The brand value is nothing but the future stream of revenue which you are going to get from that particular brand. And then we are trying to calculate the present value. We arrive at a figure. Because whenever I have to buy a brand, whenever I do mergers and acquisitions, or whatever I want to do, I need to give a value. How much I want to pay. So I think we need to wrap it up. So anybody else now? There are a lot of other methods are there which I have not discussed. A lot of other methods are there which I am not discussing because time is not there. Let's see other one. Just going to check what other people use. Methods of brand. Methods of brand. Yes. Fast. Okay. So these are the methods. Okay. So we have spoken about some cost-based, some market-based, income-based approach, other brand direction approach, formula approach, brand finance. So there are a lot of other methods. I think because of time I will not discuss. So this two I think I have covered. Okay. Brand sale comparisons I have covered. Demand driver also have covered. Price sale is very easy. Okay, you have a brand value and compare with sales. You arrive at that. So operating profit, comparison margin, ROI, this method we have covered, which being used by brand sales. This method just we have discussed. Incidentally, this method is used by brand finance, income based. Excess cash flow and then price volume. Very similar. Excess cash flow is very similar to your whatever you're talking of intrabank kind of thing. You're trying to estimate your cash flows. Economic profit. So these are some of the methods I don't have time to discuss because our Sam will be big today. We have 11:50. Yes, sir. Sir, what time will leave from here?
Sorry?
What time are you going to say goodbye to
As
us?
soon as we finish.
Okay.
Yeah, as soon
We
as
have
we
got a
finish.
flight, so we have to wrap it up. Okay, thank you everyone.